My name is David Chikansky. I'm a portfolio manager here with the Title Financial Group. We are the ETF think tank, and very pleased to have Gary Brode on the show today. Lots of exciting stuff on GameStop Thursday. Stock got stopped out a couple times throughout the day, so we won't focus too much on that, but we might riff on it a little bit later. I'm going to kick it off to my colleague, the ETF professor, Dan Weisskopf.
Hi, everybody. Dan Weisskopf here, otherwise known as the ETF professor, also a portfolio manager at Title, like David, and always thinking about blockchain. I'm the portfolio manager with Mike Venuto on Block. With that, let me hand it off to Gary Brode. Gary, you write a great report called Deep Knowledge Investing. We appreciate the research you provided and also follow you on Twitter. So tell us a little bit about yourself and we'll get right into it.
Thanks, Dan. I appreciate you guys having me. And thanks to David and Michael for the invitation. I started in the business in the M&A department at Morgan Stanley back in 91. In 93, I moved over to the buy side and did risk arbitrage, special situations, event-driven investing. Spent a couple of decades doing long-short equity investing, all kinds of concentrated long-only investing. And in January of 2020, started Deep Knowledge Investing, where I work with hedge funds, RIAs, investment managers, family offices, and individuals and help them get better returns in the stock market.
Love that. So bring us up to speed in case somebody doesn't follow you on X, what your broad parent thought process is around these markets.
So I think I had a different view than the consensus narrative coming into this year. Obviously, in the fourth quarter of last year, people were saying 6 rate cuts for a total of 1.5%, starting in January, maybe in March, and we were just saying not a chance, no way. I think there were 2 areas where I disagreed with people. One is government spending, right? The government right now is trying to stimulate the economy. They're overspending by $2-3 trillion a year. That's just the on-balance sheet number. If you want to include the off-balance sheet, add another $4-6 trillion on top of that. Those are real expenses. They're just not incurred yet. And so, we've got a government that's spending like they're trying to pull us out of a recession at the same time that everyone's trying to tell us we have a phenomenal economy. Something doesn't really add up there. And I've written a lot this year about the secret war between Powell and the Fed on one hand and the Treasury and Congress on the other, where Powell is trying to raise rates to get inflation under control and Congress is overspending to stimulate the economy and the Treasury is just monetizing everything. And so everything they're doing is offsetting. And that's why, Powell keeps talking about the current Fed funds rate as being restrictive. It's not. The real rate is still under 2%. And, with Congress overspending, they're adding something like $1 trillion of debt every 3 or 4 months. It's simply not sustainable. And it's not investments. They try to convince us it is. It's simply consumption. I think the other area where I disagreed is people have this hope that Powell's biggest concern is to keep us out of recession. I don't believe that's true. And I understand it's always difficult to guess what's in somebody's head. But my view on it is Powell understands that Arthur Burns, who is the author of the 1970s inflation, because he let up on the Fed funds rate too early. He thought he had inflation under control. He didn't. And then it took Volcker jacking up rates to almost 20% or around 20% to get that under control. And the fact is, Volcker could do that back in the late 70s, early 80s. But with, what do we have now? $36 trillion of on-balance sheet debt? That's not an option. And so Powell's got one shot to get this right. And I think he's a guy who's concerned about legacy. And I think he's concerned that if inflation comes back up again, after he reduces the Fed funds rate, he's going to be the next Arthur Burns, and that's going to be his reputation. Putting the economy into recession, I don't think he wants to do it, but I don't think that's his primary concern.
I think watching the expectations of rate cuts this year was absolutely amazing to watch. But since then, we've seen the long end of the yield curve fall a little bit, mainly because of some JOLTS data, some PMI data, some potential softening of the economy or data coming out on that side. But what I find fascinating now is the expectations for rate cuts is so concentrated in this like small band now over the next couple of years. It's unlikely that that occurs, right? It's unlikely that it's just kind of this smooth path there. So what are you seeing going forward? Some people, I would probably say if there is a rate cut, we're probably talking earliest December, maybe one rate cut in December post-elections, far enough away where it doesn't look political. But that's a total guess, to be totally honest. So like give us some thesis on what the next like 6 to 12 months might look like on that side.
Actually, David, I like your analysis on that. And here's why. I don't think there's the probability that they cut at the upcoming meeting is right around the zero. I just don't think that's likely. So now we're looking out, do they cut in September, in November? And, one of the things the Fed is concerned about is they don't want to appear to be favoring one political party or another. It's an election year. Changing rates, right before an election. The truth is they could change rates in September and it's not really going to affect the economy a whole lot, but it will make the Fed look political. It'll make them look like they're favoring one party or one candidate over another. Whether they do or not is irrelevant. I think they don't want to appear that way. So once we get out past June, I think if they want to cut rates or change rates, they're probably looking at December. And at that point, it's just not going to be that big. Like the circumstances where they'd be cutting 75 basis points in December, we'd be in a massive recession. That's not going to be good for stocks, right? So people who are looking for rate cuts to bail them out of their portfolios or to blow up another asset bubble, the circumstances where they make a big cut all at once, those aren't circumstances where stocks are going up.
So some of this he doesn't control, right? Let's be honest about it. What's happening in Japan will influence potentially, the dollar and global economy, right? Talk to us a little bit about Japan and how they're managing rates right now and what the implications are for us as well here in the U.S.
Thanks, Dan. So I actually owe a big thank you to Michael Gayed on this. I started writing and speaking about the issue in Japan in October of 22, and Michael hosted me the first Twitter space I did with him. It was Twitter then, so I can say that. But the first Twitter space I did with him was an hour of talking about the situation in Japan. That was, more than a year and a half ago. And so I owe you guys a huge thank you for, helping me get that idea out there. But basically, Japan is trapped. What they did was they kept rates below zero for almost a decade. And because the debt didn't cost them anything, they ran up gigantic debts, right? And we talk about us having a debt problem here in the US, and we do, but in Japan, their debt to GDP is over 260%. And so they're really stuck right now. The yen 2 years ago, I think, was 102 to the dollar, 103 to the dollar. Last time I looked, it was 156, 157. That's a 50% change. And remember, Japan has to import fuel, which is largely priced in US dollars. So if you're Japan, the problem that you have is if they don't hike rates, the yen's going to continue to slide, and that's going to make things very expensive. The issue is if they do hike rates, that blows out the budget. They have to do what Yellen's doing right now, which is monetize that additional debt. More currency creation leads to more inflation. So no matter what happens, they have a bit of a problem, and they've been slow on it. You remember, what was this, like 2 months ago? The Bank of Japan, they came out, they made a big deal of saying, we're going to raise rates, we're going to go positive. And then what they do, they raised rates by 10 basis points, and the reference rate was between 0 and 0.1%. And the market laughed at them, right? The yen did not move on that. And then what they tried to do, they threw tens of billions of dollars at trying to defend the yen. And, for people who aren't following this all the time, what that means is Japan took their foreign currency reserves, they own dollars, they own euros, and they sold other currencies and used that money to buy the yen. And so what that would do is it would raise the value of the yen, like 2 or 3 or 4 yen against the dollar. And that would typically last somewhere between 24 to 48 hours, which is not great because you're just blowing through foreign currency reserves, but they're not addressing the issue. They're not addressing the underlying issue. And I think that's their problem. And for people who think I'm picking on Japan, I'm not. I think we have the same problems here in the U.S. I think, with our debt, we're kind of trapped at the moment as well. And so, I'm hoping Japan finds a way out of it. But I think they're going to need to raise rates, and that's going to create more of the same problems they're trying to avoid.
So we know a lot of folks here in the U.S. particularly are overweight with the home bias in the U.S., right? And we're trained as most investors to invest broadly, strategic allocators, 60/40. Do you think we're headed for a situation where people start being more targeted with which country exposure they want? Because people really don't want China, for better or for worse, right now, right? But people do want India.
Right.
So, you would maybe say that Japan is not a great place, or maybe you think it is a good place. But we can now, with ETFs, target our portfolios much more than we used to.
That's absolutely true. And things that, when I started in the business, the idea of buying, an ETF for a country or a sector in a country, that really wasn't so much of a thing. I think you were talking about China. The issue there is not only regulatory, it's accounting. I think you're right. India is potentially interesting. The other thing too is you're right. People, they like to invest in what they know. And right now, people are largely comfortable being here in the U.S. We do have some, whether the economy is good or not, we do have some phenomenal companies here. And the regulatory framework is such that people have a great degree of confidence. And, certainly there is fraud, but it's relatively rare. And the way we know that is every time it happens, it's a big deal.
Along those same lines, though, you are highlighting the risk of a recession. And people forget recessions aren't necessarily the worst thing in the world. It's a question of how deep is the recession, right? When you look at Japan, their equity market has done very well, putting the currency issue aside, right, for a second. Does that surprise you, given their issues around debt, that their equity market could do well?
So I think that we should break that out into real and nominal, and I'll explain. So you're right. The Nikkei index has gone up an enormous amount the last couple of years, and part of that is the fact that the yen has been incredibly weak, right? So if you're a Japanese company, you get paid in foreign currency, and if your currency is weak, that makes your product relatively attractive. So that's worked out really well for Japan and their exports. But the issue there is the currency has been so weak. We saw last year all of these, earlier this year, all of these great reports about the huge run up in the Nikkei and the Japanese index. But when we charted it in dollar terms, the index was not up. And so, so two things. One, I think, when did they last make their previous high? Was it 89 or 91, something like that? Okay. So 40,000 yen in 1989 bought you a whole lot more than 40,000 yen in 2024. So to simply say, hey, the index is up a lot, it's at all-time highs, maybe, I don't know about that. But then even if we look at just the last few years where the index has gone straight up, if you convert that index into dollars, it's not up. So, here's the other thing. Dan, you were talking about, should U.S. investors be looking overseas? And, in certain situations they should, but that also means you're taking foreign currency risk. And if you don't want to take that foreign currency risk, congratulations, now you need to own a hedging position. And, so you're going to buy the Nikkei, short the yen, and, if the Bank of Japan raises rates, you just blew out the hedge on your trade. So no matter what you're doing there, you're taking a lot of event risk, particularly in that currency.
Can we move over to employment and talk a little bit on that side? Because we have this unique environment of overall pretty strong wage growth. As you and I briefly discussed before the call, a little bit of a K-shaped economy where it's benefiting some more than others, those who had assets to go with a pretty strong income as well. But it's unlike other traditional cycles. So some combination of decent wage growth with a bifurcated effect and also a bifurcated effective type of labor between full-time employment and part-time employment, with a lot of rise in part-time employment. How does this unwind? Because whether this ends up being more inflation or deflation, it's definitely something people haven't really seen in the U.S. in the last 30 years. So playing it out from a macro perspective is the difficult part. So,
yeah, I think our employment numbers are. I actually used to feature the employment, and we read a weekly piece called "The 5 Things to Know in Investing" this week, and I regularly had the employment reports, and every week, every month, there's information. The numbers we're getting are so unreliable that I just stopped covering it. The numbers are clearly made up. What was it earlier this year? The Philadelphia Fed realized they'd overstated employment by something like 800,000 jobs. So let me just start by saying I don't believe any of the employment numbers, but if you do believe them, there are a couple of issues that we see. One is there's been no full-time employment growth in years. All of the growth that we have is part-time employment. That, combined with the fact that the unemployment rate has been largely unchanged, leads me to a conclusion here. So people keep telling us that we have this great economy and unemployment is low and the employment market is great. Okay, fine, but we don't have more people working. The same people are working more part-time jobs to make ends meet. And, on one hand, listen, great that people are working, great that they can find jobs, but I don't know that people who have part-time jobs taking on second and third part-time jobs to make ends meet is indicative of a strong economy. Right? I don't know that we look at that and start throwing a parade and saying this is terrific. The other thing I'd point out is the statistics are starting to come out. There's been no growth in employment for people born in the United States in about 5 years. 100% of our employment growth is people who are coming in from other countries. And, that's not necessarily a bad thing, but, we're seeing issues where the government is supporting foreign-born workers against U.S. workers. And, that's something that I have a bit of a problem with. So, for example, imagine you're born here, you live here, you have to pay rent or for your home, you pay taxes. And now what's happened is, a lot of the people that have been flown into New York, they're being given free housing, free food, they're being given papers to work. And so because they have no expenses, right, they can work for lower wages. And, that's great if you want to hire service people. That's terrific, right? If you're hiring labor, that's a really nice thing. But there's something to me that's wrong and unfair about the government basically using foreign-born workers and supporting them so that they can compete with domestic workers at lower wages. Again, I think the numbers that we're seeing are not indicative of a strong economy. And, I realize some of the stuff we're talking about here, or that I'm talking about here, may be contentious because the issue of immigration is a political issue and people get really charged. But I think it's okay to express a concern for the people who were born here and live here and pay taxes and who want to compete on an even playing field for jobs.
Dan, just one comment on to the riff off that, and then I'll pass it on to you. I think at one point in 2008, one of the GDP numbers got revised as far backwards as 18 months after it actually occurred. So, all of this could be a moot point in 12, 15 months from now. So, Dan, take it off.
That's a great point, and it really is. So you're Gary, you're painting a pretty bleak picture, right? And I'm not going to say that you're wrong. The statistics are in your favor for sure. Was there a period of time where you were more optimistic? And because the debts existed, right, for a while, what led to your change of view?
So I don't know, Dan, that I've had a change of view, and it's really important to point out that one of the things I see is when I see issues in the economy or in finance, that I disagree with, or that I think are negative, or I think are taking us in a bad direction. I pointed out, people often act like I'm cheerleading for that to happen, that I want it to happen, that I have influence and can make it happen. None of this is true, right? I think I see what I see. But one, don't get mad at me. I do not have the power to cause these things to happen.
No.
Two, I think a lot of what's happening is not good. I'm not cheerleading for it, but it's really important. People talk about their emotions a lot, and that's fine. If you want to talk with your parents, your wife, your spouse, your friends about your emotions, that's terrific. But when it comes to investing, it's better to leave your emotions out of it. And, people talk a lot about, what keeps you up at night and what causes you stress. For me, whether I think it's a good market or a bad market, a good economy or a bad economy, it's my job to find ways to make money from it, to take the people who subscribe to deep knowledge investing, my partners, my clients, my subscribers, and help them get through it and help them protect their homes, their nest egg, their retirement, their portfolios, or even make money from these things. And so, listen, would I prefer that things would be different? Of course, but it's my job to come to work every day and say, okay, things are the way they are, whether I like it or not. I can't change that. How do I help people? How do I help people navigate through a difficult environment? The one thing we're not allowed to say at Deep Knowledge Investing is that, it's a good market, it's a bad market. We can't do anything about that. It's our job to find a way to help people and to make money no matter what the conditions are. So I don't think I'm optimistic or pessimistic. I think I'm a pretty sunny person who just sees things the way they are and tries to make it work.
So you run this report called Deep Knowledge Investing. In case anybody's not sure, it's above your right shoulder.
Yeah.
And I know you probably don't want to give away your intellectual property for free. And people should subscribe to your report. But what are you saying that, just broadly speaking, how people should invest? I mean, frankly, I've gotten the bond market wrong for 40 years. I've always been very, very short. 3 years is long for me. So I missed the rally, but I didn't get hurt in the end waiting 35 years for it to fall apart. What are you recommending, or what are you suggesting in your report?
Sure. I look at 3 parts to the portfolio. One is we were just talking about the massive debt that we have. No matter what, we're going to be seeing more inflation. And, by the way, even if the Fed were to hike again, and Kashkari was out last week saying, hey, maybe we need to hike. I don't think that's going to happen in the next few months. But even if they did, what that means is higher interest expense, more printing, more inflation. So no matter what, we're going to get more inflation. So I am negative on the dollar. Again, for people, don't get mad at me. I'm not cheering for it to happen. I cannot force it to happen. It's just the way this is going to work. And so I like dollar alternatives. I've owned gold for a few years, which is right now around all-time highs. My largest position is Bitcoin, and it did not start as my largest position. It just up, 5x from where I bought it. Also, as a dollar hedge, we own huge amounts of energy. I think the whole world wants to live at a higher material quality of life. That means more energy use. All of the AI stuff that everybody's excited about, right? Who's going to power that? You want to have electric cars? Great. Somebody's going to need to build a grid. And so we have large positions in oil services. My second largest position is in uranium. I know Michael's been out talking a lot about nuclear energy. We just did a webinar with Enrique Abeda from HX Research on Talon Energy, TLNE. And, Amazon just bought a data center that's next to a nuclear plant that Talon has. I think the future of nuclear is going to be fantastic. And new demand is going to come on before new supply. So there's just, people look at the chart and they say it's played out. I don't think it's played out. I think there's more to go on that. And then the third part is I'm a stock picker. That's what I've done for, almost 35 years at this point. And so as a stock picker, I still find individual equities that I like. I've been hedging a lot of that. And, while the hedges haven't gone particularly well, shorting the indexes against that exposure hasn't been great. But the fact is we've generated a lot of alpha, which is just a fancy finance way of saying that our longs have gone up by much more than the market has. So we've taken risk way, way down and, still managed to perform really well.
I totally agree with you on the infrastructure issue. With AI, we've been overweight some great holdings in our fund from that. And who knew, right? There's a shortage of infrastructure. So anyway, Dave, you got a question or thought?
Yeah, I was wondering if you could. I know you talked a lot about a number of different commodities. What about all the battery metals? Where are we with this whole EV space? We've seen, the best performing car company be, I think, Toyota, because they are more hybrid than EV. But the lithium space seems to be one of the only commodity spaces that obviously commodities have been softening as of late, but just have been completely dormant all year long. And similar to you, I've kind of expectations of everything being overpriced, and I think uranium is a big part of the future, but looking for things that are actually in the supreme value category, there's not that much. So any thoughts on the lithium space?
That's a tough one. Anytime I've looked, if you look at the estimates for how many EVs they expect people to be driving, and then, you figure, what do you need? Something like, it's like 1,000-pound battery and something like 300 pounds of lithium. Good luck. Where are you going to mine all of that? The other thing is we don't have the grid capacity to have these EVs. Customers are starting to rebel. They don't want them. So I think there are all kinds of issues with that. The other thing is I also don't believe that EVs are as environmentally friendly as people say they are. They refer to them as zero emission vehicles, but they're forgetting the fact that the power to charge it comes from somewhere, and that you need an enormous amount of diesel to mine lithium or mine anything. Or they're not using battery vehicles as mining vehicles. Those are all gigantic diesel engines. And then, mining rare earth elements, mining things like lithium, that is horribly environmentally damaging. The reason people here don't think about it, and they think about it as being very clean, is these things take place in China, which has relatively no environmental controls, or in Chile, where they have other concerns. And so, if we had lithium mines here in the country, I guarantee you the photos of those things would be in the newspapers, and people would be saying, what in the world are we doing?
So last week, Dave and I were on with Ron and Sana, and the Trump verdict came down. And for me, it was a little bit of a moment in time that we could share. I'm not going to ask you about your political views, don't worry. But is there a positive outcome from the election in the way of which presidential candidate, assuming the obvious takes place between Trump versus Biden, where the economy is boosted by one or the other, in your view?
I think the one of the things President Trump did really well in his first term, in his only term, however you want to phrase it, was reduction of regulation. I think he took something like 20,000 regulations out of the Federal Register. I'm a huge believer that businesses in this country are overregulated, and it's a gigantic problem. My dad is a financial planner, and every time I talk to him, he tells me his workload for lower and lower fees goes up and up. And it's not more time spent helping his clients or serving his clients. It's just complying with an overload of regulatory requirements. And everyone I talk to feels crushed by this. And so, I do think he was very good on that particular issue in that first term. More importantly, I think the key thing that the United States needs to do is we need to cut the budget. We need to spend less. I know Michael has written about that on Twitter or X a lot. I agree with him on that. And, the unfortunate thing is neither candidate for president, neither party has any plans to cut spending. Spending only goes up. And, there's misperception. Yeah, every time I say we need to cut spending, people always say, oh, yeah, so you're on the Republican side and you hate Democrats. No, both parties overspend. It is clearly a bipartisan problem. Take a look. President Bush was a big spender, and then Obama blew out those budgets. And then, President Trump ran and people said he's going to be a conservative. He wasn't. He spent more than Obama. And now, the budgets have gotten even larger. No combination of Republican in the White House or the Senate or Congress, no one has any plans to cut spending. It's just not going to happen. So, one of the things I've told people is we can't vote our way out of this problem, not with the candidates that we have, not with the two parties that we have. Nobody has any plans to cut spending. And so, again, that doesn't make me pessimistic. It just means I see it for what it is. So everyone prepare for more inflation. That's what's coming. The purchasing power of your dollar is going to go down. At the moment, I own enough dollars to pay my bills and my mortgage, no more.
But really the question is against what, right? Because the economy showed a little signs weakening. 10 years flew all the way down to 4.3%. But everyone knows what you're saying is true. Even high yield was able to roll over their debt, has much less of a maturity wall in the next 2 or 3 years. The entity facing the maturity wall crisis is the U.S. government, right? So how does that happen with yields falling? That's what I think is so complex about today's markets. So.
Yeah. So regarding yields falling, at which part of the curve? The other thing, we were talking about this earlier. One of the things that Yellen is doing, Treasury Secretary Yellen, is when she rolls over the debt, she's doing so for shorter periods of time. And so, think this through for a minute. Imagine we have debt that comes due and we roll the debt. And if you finance it for 10 years or 20 years or 30 years, then you don't have to refinance that debt until 10, 20, 30 years down the road. But if you only finance it for 6 months or a year, you're going to need to refinance it against it. And that's what they've been doing. And so the near-term treasury auctions have been getting larger and larger. The tails have been getting larger and larger. Again, that's just a fancy way of saying that there's less demand to buy the treasury securities than they had hoped for. And so they're having to cut price on this along the way. And so, we're going to see more of that. And you're right, David. It's been a situation where, it's nothing goes to heck in a straight line, right? And I don't know. And, we certainly could have a situation where, every other country cuts rates first, the dollar gets stronger, right? And things go in a different direction. I think that's a temporary thing. It's hard to know exactly where we're going to be a year from now, but it's really easy to see where we're going to be 5 to 10 years from now.
And to your point, I find that the majority of people are hoping that inflation is going to go down and be under control, but there isn't real evidence that that's going to happen. That's the problem. It's like they've got confidence because of the near-term statistics of late, which maybe revised, right?
So, Dan, one of the things that I think is really interesting is, here's my quiz for you guys. Who on the planet would be best positioned and have the most information to figure out where inflation and where rates are going to be a year from now? It would be the governors of the Federal Reserve, right? They can control rates.
I thought it was a trick question.
No. It's a simple question. They have control over the outcome, right? And they have more data than anybody else. And so I'm going to give a shout out to Andrew Brown, intern at Deep Knowledge Investing from the University of Tennessee. I had Andrew go and pull every one of the dot plots for the past few years, and we charted it. And here's the beauty of all of this. If you take a look at the Fed dot plot, at the beginning of 2020 or 2021, the beginning of 22, where are rates going to be at the end of the year? They've got their dot plot. Guess what? They're not even close. They're not even close. 12 months out, the Federal Reserve cannot predict where the Fed funds rate is going to be. Forget inflation. They can't predict the one thing they control. And so, yeah, who in the world? Like, it's, if they can't do it, I don't know why anybody would expect that to happen. I will tell you one place where I've had significant disagreement with people. I think, Dan, that what happens is there's a normalcy bias. And I think you were implying that, right? Everybody assumes that inflation will trend toward 2% because it's supposed to, and that's where we're supposed to see it, right? And so everybody assumes this is where we'll end up. The problem is with Congress overspending by trillions of dollars a year and the Treasury monetizing that, we may have a different reality, right? The normalcy bias is where were we yesterday and 5 years ago and 10 years ago, and that, that may not be the case. But, I've long said the proper and moral rate of inflation is 0. And that gets people very upset. There is this normalcy bias that you need inflation to have GDP growth, and that is 100% not true. A stable currency encourages long-term investment. It encourages people to save and invest. A currency that's being depreciated, where you have a lot of inflation causes people to go out and spend, right? Because it's going to cost more later. And I keep getting these arguments from people saying, oh, but if we have deflation, we're going to have a horrible recession. The whole economy will grind to a halt. And I say, why? And I say, well, no one will spend anything. Okay, that is completely not true, right? And for everyone listening to this, think about everything you've spent money on in the last year. So either rent or your mortgage, your home. Would you have lived on the street because housing could be a few percent cheaper? No, you wouldn't have. Food, right? You can't defer that purchase. You can decide to stock up your pantry or not, but you can't defer that. Having a car to get to work, putting gas in the car, right? All of these things, most of what people buy is not something that they're going to defer. Are you going to not get childcare, daycare for your kid? Are you not going to send your kid to college because it might be cheaper a year from now? Right? All the big expenses we have. And think about it another way. Like, let's say you move into a new house, you want to buy a couch for $1,000 and someone says, hey, listen, there's going to be deflation. We're going to have 3% deflation. And they say, oh, I could save $30 by sitting on the floor for a year. And by the I don't believe it. And the best proof of all of this is a huge part of the economy, right? What's the biggest stocks in the market are what? Our tech stocks. So take a look, the price of TVs, computers, laptops, tablets, cell phones, everything that you have, everything that you buy this year, your electronics will be worth less in a year. They'll be worth much less in 2 years. And yet we're still buying iPhones and Samsung Galaxy, this and that. And people actually will buy things even though they know that computer will be worth less in a year. You won't be able to sell it for the same amount. So I don't actually believe that the economy grinds to a halt if the value of our money holds its value or even increases in value, right? Look at what happens when you have a 0 savings rate, everybody's spending. No one has a nest egg. No one has any security. But if you encourage people to save by not debasing their currency, you have more investment. You have less consumption. That's not a bad thing for any of us.
So, Gary, I don't want to lead you down a rabbit hole where you're a fear monger. Don't get me wrong. But why isn't the picture that you're painting more like stagflation than anything else? If we have inflation and we're going into a recession, call it whatever you want. Isn't that like the worst of all worlds, with otherwise known as stagflation?
Yeah, that would be the worst of all worlds. Well, certainly we have. So stagflation is a recession with inflation, right? We definitely have inflation right now, right? If you believe the CPI, inflation's around 3.5%, depending on whether you're looking at the regular or the core. Now the super core, at some point, we just exclude everything and inflation is 0, right? My joke on it is, there's the DKI, ultra core index, which is the estimated price of the estimated value of an apple that's been in Jerome Powell's refrigerator for 2 months. These numbers are made up. And by the way, I'm just going to say on the record here, I don't believe the CPI. It's a fake number. It's not real. That 3.5% isn't real. Take a look at the difference between OER, owner's equivalent rent, and the Case-Shiller or Zori, the Zillow owners rental index. housing prices that real people pay have gone up a lot more than OER. They're trying to tell us food inflation is 1%. Find me somebody whose grocery bills are up only 1% in the last year. Right. I don't
actually, that actually might be, sorry, but Michael Guyat.
Right. But he stopped eating. Guys, I think he eats once a month now. Right. And the thing I can't figure out, like, he doesn't eat for a week, and he'll tweet, just got back from the gym. I'm like, how you haven't eaten in a week? How are you lifting weights? I don't get it. He's superhuman. The hardest working man in finance, definitely.
Just to play devil's advocate on the inflation point, the other side of it is that a lot of the sticky high numbers are backwards looking payment, insurance, auto payments, things that are reactionary to rates rising over the last 12 months. What are your thoughts about that? Because I've always thought that, again, we talk about all these things never occurring in a straight line. And if your thesis is at some point that we can be in a world with like no inflation or deflation and just flat, especially like at some point we actually have to dip below that. So when does that potentially occur? I think deflation is just as much of a risk as like rampant inflation here. What are your thoughts on that?
So first of all, I would not phrase deflation, otherwise known as the dollars you already have maintaining or gaining in purchasing power. I would not consider that a risk. I'm not worried about people having more purchasing power. The point that you're making about some of these things being on a delay, right? It's not so much that they're backwards looking as that they're on a delay. I think that's valid. The thing that I would point out is, like, on the used car side of things, if you look at the Manheim index, that's been falling for like 18 months pretty consistently. And so, is it a little bit behind? Yeah, probably. But if it's declining consistently, that decline is being captured in the monthly numbers. Now, certainly the property market by definition is slow to adjust. If you think about it, if you make an offer on a house, that offer is accepted, you go to contract, you lock in the price then. But it might take you a month or two to get to closing, to get the financing, to get all the conditions set, your inspection. And then even then, it'll take another month to get it reported. So the property market will often work on like a 3-month delay. So I agree with that point. But the other thing you guys were asking about stagflation, I think the real economy is in a recession right now, but I think the nominal economy is not, and the difference is simply government spending. There is no way in the world anybody in Washington from either party wants to run for re-election with an economy in recession. They will spend however much they have to make sure the GDP number remains in the black.
So I understood that some of the fast food restaurants lowered price. I think it was Chipotle recently. I don't know if it's true or not, but my point is more that in certain ways things become structurally set up a certain way. My daughter just bought a car. She lives in North Carolina. Because she's older than 21, she had to take out a separate insurance policy, okay, to get the car. Okay, fine. That was $150. She took the insurance policy. Now, when I went to Geico and I said, okay, good, she's now insured under your firm, can I remove her from my policy? They said, no, that will have to raise your price then. And I said, wait. You're taking less risk, but charging me twice, right? Or charging me twice. How is that possible? Well, but sir, I'm saving you money, right? What other things do you think are like structured a certain way where lowering price is rigged? Is part of my question. By the way, thank you for the reaction. I'm glad I'm rational because it made no sense.
So not only does that not make sense, I had a similar experience, only without the daughter. So, my daily driver is an E46 M3, really fun to drive, manual transmission, just super fun. And then a few years ago, I bought a truck, right? But I used, F-150 with like 80,000 miles on it. And, I think it's approaching like 20 years old, something like that. And so my insurance company said, well, we need to charge you more because we're insuring 2 cars. I said, what, are you kidding me? I said, guys, every mile I'm not driving more. Every mile I spend driving the truck is mileage that's not being put on the expensive M3, right? Like you want me to have a cheap beater truck that is, pretty much a tank that weighs 8,000 pounds.
Yeah.
Like, how do you not want me driving that? Instead, you should give me a rate cut. They said, no, we have to charge you more because there's a second car. I'm like, what? It makes no sense at all, right? If I were the insurance company, I would choose the opposite. So I completely agree with you. There are all kinds of, nutty decisions made like that. The thing that I would point at, and this is where, there's been a huge debate on Twitter or on X. It's the misunderstanding between price levels and the rate of change. And so, what we saw, and again, I don't believe the CPI, but let's just assume for the purposes of this conversation that the CPI approximates inflation. And so, what we saw was the CPI come down from, 9.5% to 3.5%. And the pro-government people were saying, this is fantastic. We have disinflation. And, ordinary people were saying, wait a minute, the prices I'm paying for things went up an enormous amount last year. And now they're going up again this year. And people are saying, hey, it's just 3% more. And they're like, no, it's 3% more on top of the 9 or 10% from last. It compounds, right? And so, economists like to look at rate of change, and normal human beings like to look at price levels, right? And the guy, I have to give him credit, the guy who does this bit more clearly and more funny than anyone else is Rudy Havenstein, on X. And he regularly pokes at the central banks. But, this is the kind of thing where I think there's no one better at presenting this kind of thing in a funny way. He's always doing a bit where an economist is interviewing, a housewife who's shopping at the grocery store and saying, aren't you glad, with all the disinflation? And her response is, I can't afford my groceries. So I think there's a lot of that going on. I think people are talking past each other. Disinflation, a reduction in the rate of inflation, means we still have inflation. It's just at a lower rate. But, for 95% of the country, their prices went up, and then their prices went up more. And now this year, their prices are going up more, but at a slower rate. And they're just getting crushed by that. And that's the thing they're looking at. And when you talk to them about the rate of change and disinflation, you're really talking past them and their needs and how a normal person views this stuff.
So you mentioned Bitcoin. I have to ask you, your moment, your orange pill moment. How did you come into it? It's obviously very aligned with your thinking, right? But give us some background on that, please.
Bitcoin came to my attention maybe 8 or 9 years ago. I knew about it kind of early, and I had spent my whole life as a stock picker, valuing companies. And my response for years was, but how do you know what it's worth? How do you value it? It's not worth anything. And I was a little bit torn. And I know I said before, take your feelings out of it, right? When I'm investing, my feelings are irrelevant. But the way I felt about Bitcoin at first was, I don't know how to value this. I don't know that it's not worth zero. But as somebody who objects to the power wielded by unelected bureaucrats at central banks, as somebody who sees the danger of printing endless amounts of fiat currency, I really wanted it to work. And when my friends who own Bitcoin would talk to me about it, I would say to them, I'm not buying it, but I am cheering for you. I want this to work. It is a giant screw you to central banks, and I am on your side. And, then we got into 2020, and I saw the government taking $6 trillion, and they went full helicopter Ben, right? Ben Bernanke, about a decade ago, was talking about, if you needed to stimulate the economy, you could just throw $100 bills out of a helicopter. And our government tried that. We basically had universal basic income. They were just sending out checks. They were sending money to everybody. And I saw that and I thought, this is a big problem. And all of a sudden, the things that had no yield, but were hard, meaning difficult to reproduce, started to grab my attention. And in 2020, I bought gold for the first time in my life. I had never owned gold, and I saw this. And then, by late 2020, I just started to see the writing on the wall with Bitcoin and started to realize that, if you don't want to own a huge amount of gold, and that's not a bad thing, then you're going to have to own fiat. And I didn't want to own fiat. And switching from the dollar into a different fiat currency, that wasn't going to solve the problem. And so, I started to buy more and started to learn more. And the government, that spending wasn't one time. We're still overspending. Yeah, we didn't throw an extra 6 trillion at it, but we're still overspending by trillions of dollars a year. And so as these problems compound, I got a lot more interested in things like oil, uranium, gold, Bitcoin. And then, Bitcoin made a lot of the decision for me where, you establish a position and something goes up 4x, 5x, and you don't want to sell it. It becomes a big part of the portfolio. And so that's where I am on it. And, one of the things that bothers me, I think the Bitcoin community can be very welcoming, but they can also be really rough on the non-believers, right? That have fun staying poor is horrible persuasion. It's snotty. It's a bad way to persuade people. And, one of the things I always say, because there are times I talk to people and they say, I can't get there. I don't want to own it. It's not worth anything. How do you know what it's worth? And my position on this is, as somebody who knew about Bitcoin for years, before I saw it, before I understood why it was important, I have grace for people who haven't seen it yet, right? How are they any different from me, right? I'm a professional investor, but it still took me a while to see it and a while to understand the macro backdrop. And so when I talk to people who say to me, I don't want to own it, you know what? No problem. I totally understand how you feel because I felt that way. I felt that way for years. And you know what? When you see it, you can buy it then and you don't need to eat crow. But it's just bad persuasion to tell people that they're idiots for not seeing the world the way you did, because most people didn't buy it the first time they heard about it. For most of us, it took us a little while to get there. And, if you're listening to this and you don't own Bitcoin yet, that's fine too. You don't have to do it. I'm not, a Bitcoin salesperson, right? No, nobody gets a commission on selling it. But the thing I will tell you is, if you come around to it later, that's okay too. I don't think you missed it, right? People saw the run up from 15,000 to 70,000, said, oh, I missed it. You didn't miss it. And it's okay. There's nothing wrong. You're not going to be poor because of it. And you can buy it now, or you can buy it a year from now. But whenever you see it, whenever you understand it, that's okay. People should extend the same grace to others that I extended to myself. Once I saw it, I didn't think, oh, I'm an idiot. I thought, oh, wait, this is really an opportunity. So there's my counter to you guys calling me pessimistic. I'm, a happy person here.
It's funny. I remember when I was first starting in the business, brokers would call me and they would say, oh, I think you should buy this penny stock. And I'd say, no, I'm not interested. Wait, you don't like money? Would be the response.
Yeah, right.
I mean, come on, stop. There's no guarantees in life. And by the way, Bitcoin will go down. I don't know when it goes down, but it will go down.
Well, I'll tell you what. It went from when I owned it, it ran up to 67,000 and then ran back. I think it broke 15,000 on the downside. And not only did I not sell, I didn't panic. I didn't get upset. I didn't sell it. People would say, how much have you lost? Nothing. What do you mean nothing? One Bitcoin is still one Bitcoin, right? It's like we've had inflation. You have $1,000 in your bank account. How much did you lose? Nothing. I still have $1,000. Oh, okay. Right. It's the same thing. But what we did then was, at the time, this was before the ETF approvals, Grayscale, GBTC, was trading at like a 25-30% discount. And so I backed up the truck, and instead of buying Bitcoin and self-custodying, I was buying GBTC at a 25, 30% discount. And then when it ran up from 15,000 to, the current 70 plus thousand, our returns on it, because once they had got the ETF approvals, our returns on it were 25 or 30% better than the returns on Bitcoin, which were in itself pretty amazing. And so, the beauty of it is there was no need to get upset. We just used it as an opportunity to get bigger and did so in a way that got us better returns. Basically, sitting with that dollar loss for a couple of years ended up being the opportunity to make more money on it. So you're right. At some point, it will go back down again. Bitcoin regularly drops 50, 60, 70%. I think it's had multiple 80% drawdowns. Okay, so what? I don't know.
Been through it. It's not just so what. It sucks.
Yeah, it does. But think about it this way. I don't know what the dollar price of Bitcoin is going to be in 10 years, but I will guarantee you the purchasing power of the dollar 10 years from now will be much lower than it is now.
David, you look like you've got a thought, or you want me to?
Yeah, I was actually gonna ask if you had gone any further into the Grayscale lineup. We had noticed a couple weeks ago a similar discount in Grayscale's large cap trust, about 40%. That was about 92% Bitcoin and ETH. I'm wondering if you have any thoughts on anything in that realm that goes a little bit deeper into the crypto space beyond just Bitcoin.
Yeah, I haven't looked at it. I understand there's a really interesting use case for ETH. The thing that I don't like about it is it's not independent. It can be centrally controlled. The rules can be centrally controlled. And I just, a lot of people will say there's crypto and there's Bitcoin. And a lot of people outside of that space view Bitcoin as crypto. Bitcoin holders view Bitcoin as different from crypto. And I actually agree with that distinction. The rule set is different. The incentives are different. The control is different. It really is decentralized where other crypto is not. So I'm not anti-ETH, but I don't own it. And, I haven't really dug in on it.
Well, we're at the top of the hour, my friend. Gary, this has been really awesome. I love the shared insights, David. Awesome. Great discussion. Any closing remarks, Gary?
Yeah. But first of all, thank you so much for hosting me. Thanks to Michael Guyot for the invitation. The thing that I would tell people is I understand that a lot of what I've said over the last hour would be considered negative or scary or pessimistic. But the truth is there are always ways to hedge your portfolio. There are always ways to make money in any given environment. And so, please don't think I'm negative and don't despair, right? There are lots of things that you can do to protect your home, to protect your portfolio, to protect your nest egg, to make money in all different kinds of environments. So, I spend all day looking for great creative ways to take advantage of whatever the current market conditions are. And so, I know I said a lot of things that might sound negative, but I'm not. And, there's no need to be afraid. You just simply have to think your way through it.
Yeah, you said it with a smile, by the way, a lot of what you said.
Well, happy to be here.
Thank you. Thanks very much. David, see you next week, my friend.
Thank you very much.